Hi everyone, this is Rob Roy and welcome to Lessons from the Market. What I want to cover in this session is dealing with earnings reports, how to trade them, issues that come up around earnings reports with any particular trades that you may have on at the time. And I've got a couple really good examples of alerts that we sent out to our subscribers very recently that talk about two different ways to handle earnings reports. Great examples. First one here is on Google, a directional trade. You can see we're in the Elliott wave 3. So the stock is moving to the upside, and I love Google with Elliott wave. It's a very liquid issue. Issues that have good liquidity do even better with Elliott wave than the normal results. The more liquidity, the better. And it's just over the years has been a great one for trade alerts. So we have the wave 3, and we want to see if that wave 3 is likely to continue. So I use the DMI. It's one of my favorite confirming indicators with Elliott wave. And you can see that we have good separation here between the green line and the red line. The green line represents the positive directional indicator or buying pressure. The red line indicates the negative directional indicator or selling pressure. So think of it as buyers and sellers, bulls and bears. The black line is the ADX, which gives you an indication of the strength. It's broken above 20. It's between the two directional indicators. That, according to the DMI, means that the trend is strong and likely to continue. So we've got a good strong wave 3. Looks like it wants to continue. So we go ahead and put on a long call spread on Google in order to take advantage of what is expected to be a continued run to the upside. And as I'm mentioning with the Elliott wave patterns here, we have a couple great examples of the corrective patterns within Elliott wave. There's a triangle, and you can see we broke out of it, and we broke out into a zigzag pattern. So we had an impulse break out of the triangle, occurs all the time. Then we had a pullback. So we want to take a look at our fib retracement just to see how far that retraced. Dead on the 61.8% level, my favorite Fibonacci level for pullbacks because it's a very strong level. And so we're in the C wave to the upside, so we can go ahead and label these as an A and a B. And then, of course, the question becomes, how far do we go from here? Well, let's advance a few days, and Google, as expected, continues to run to the upside. And then we get to an interesting point. We've continued to the upside. We've got a 40% gain already in a week in this long call debit spread that we have. And when we look at the fib extension, you can see that we're running right up against the resistance level of the 100% extension. So the 100% extension in the wave C, that's what it's supposed to do with a 61.8% correction in the B wave. So it's satisfied the zigzag. So that's going to be a pretty significant point of resistance. But we're still in the wave 3. So couldn't we continue? I actually had subscribers ask, well, why did we exit? Why didn't we continue? Well, that's where the earnings report comes in. This was on Friday, and Google was going to report earnings after the close on Monday. So we're right at a resistance level. We've had a great run to the upside. We've got a 40% gain in the position in a week. Google is obviously a volatile stock. It can move. No real way to know what's going to happen, how the market's going to receive the earnings report. And so at this point in time, the prudent thing to do is go ahead and take the gain. Take the gain and then not let the earnings report come in and cause any problems. Now, the all opposite could be true as well, right? It could have a good earnings report and explode up to that next fib extension level. Very possible, because it could be an extended C wave of the zigzag pattern. But again, what's the more prudent thing to do? Roll the dice and hope that the earnings report is well received, or take the gain that's already there, guaranteed, and just wait and see what the earnings report does. Well, in this case, we did the right thing. It always feels good when you make the right move. It did move to the upside on Monday, but look what happened on the earnings report. Boom. Big, huge drop. There's the next day, down 100 points. Had we not taken the trade off, we would have not only lost that 40% gain, but we would have lost all the capital that had been invested in the position. It would have been a complete loss. So in this case, it was the prudent thing to do, and we had plenty of reasoning behind making the decision with the fact that we had completed a 100% extension in our C wave. Now here's a different example. Same type of scenario. Stock with an earnings report on the horizon. Well, Google is in the impulse strategy, which deals with Elliott wave patterns on the directional side. This stock was in the volatility strategy, which you can kind of say is non-directional. It's non-directional in the point that we don't care which direction the stock goes. It's not non-directional in that we expect it to stay sideways. We're just not going to pick a direction. If it breaks to the upside or the downside, we don't care which one. So we've got a beautiful symmetrical triangle here with an earnings report on the horizon. The stock could break to the upside or the downside, and again, we simply don't care. Now, with the theory of earnings reports can move stocks and the fact that we wanted to stay away from it in our directional trade on Google, well, here's a strategy where we want the earnings report to move the stock. Anything that moves the stock out of the triangle is beneficial in one of these strangles, which is what the primary strategy is in the volatility strategy. And lo and behold, boom, 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 3 days later, look, huge drop to the downside. Simply 3 days later. We ended up with a 65% gain. The strangles average about 30 to 70%, so we're at the high end of the range of what they make anyway. Happened in 3 days, and it moved because of the earnings report. So here's a strategy. If you find the right pattern with an earnings report coming up where you can benefit from big movement off of the earnings report. Quite often I'm asked, why do you have more than one strategy? Well, here's a perfect example. The impulse strategy is directional. It's designed to trade directionally. The volatility strategy is non-directional in that we're not trying to pick a direction, and it's an amazing strategy to take advantage of earnings reports. So two excellent trades, both occurred within a very short period of time, both around earnings reports, but with two completely different theories. One exiting before the earnings report, one waiting on the earnings report to move the stock for us. Thanks for your attention. We'll talk to you again soon.